Welcome to the Antipodes Global Investment Call. I would like to introduce our host today, Jacob Mitchell, Chief Investment Officer, Antipodes Partners, and Andrew Findlay, Director of the company and Managing Director of Antipodes Partners. Go ahead, thank you.
Thanks very much, and welcome all shareholders and interested parties in Antipodes Global Investment Company, or APL. Today's call will last around 30 minutes. And you'll hear briefly from me, Andrew Findlay, primarily around the company and our recent results announcement that was out to the market last Friday. And then from Jacob Mitchell, who's on the line from London, who will share with you some of his market observations and outline the portfolio positioning. You should have received presentations via email if your email was registered as a shareholder of the company. If not, you can go to our website, that's www.antipodespartners.com, and click on the APL link, or else see the slides via the ASX feed. The company, as you all know, listed in October 2016, and so the results we published on Friday represent the results for our first full financial year as a company. Turning to page 2 of the presentation, I'll just highlight a few aspects of that results announcement. Firstly, after raising around about $330 million in October 2016, that amount of capital was invested in a portfolio of securities around the world. And as a listed investment company, the company's profit is primarily driven by the income and realised gains of this portfolio of investments. For the financial year ending June 18, we delivered an operating profit after tax of $34 million, which, as you can see from that slide there, was driven by the underlying portfolio performance of 12.3%. The directors and the board announced a dividend of 5 cents per share. It's a final dividend, indeed our maiden dividend as a company. That was franked to 50%. Grossed up, that equates to 6.1 cents per share, otherwise expressed as a dividend yield of 5.3% grossed up, using the share price as of last Friday. The question, I guess I can preempt as to why the franking level of 50%. Clearly we're a young company, not yet 2 years old, and franking, as you know, is associated with tax paid. We haven't generated so much tax or so much turnover or so many realised gains to date to warrant a high level of franking. And clearly the company is also concerned about being conservative looking forward, and we just want to pay dividends where possible, at least annually, subject to profits, cash flow and franking credit reserves. So it's with all that in mind that we've declared this maiden dividend of 5 cents franked to 50%. Turning the slide, looking at the NTA experience over the 12 months of the financial year, starting the year at around $1.20 per share. You can see there that the main contributor to the increase in the company's NTA was the portfolio performance, roughly 15 cents per share. As a company, we provide for tax, and that together with company expenses and options dilution, which I'll talk about in a moment, in aggregate at around 7 cents, resulted in an NTA as at the end of the year of $1.27. Now clearly the ongoing options dilution is having an impact on the share price. For those shareholders who joined us at IPO, you were issued with one option for each share acquired. The exercise or ultimate expiry date for those options is the 15th of October, and I'll talk about that in a bit more detail shortly. But as we move towards that expiry date, we expect an increasing number of options to be exercised, and that will have an ongoing dilutionary effect on the NTA. When you're thinking about performance, clearly it's not only the NTA, but also the option price that should be looked at in aggregate to consider your individual investment experience for those investors who invested with us at day one. Moving on to the key timetable and other information around dividend and options. Page 4 of the presentation. The dividend ex-date is 19 October. That needs to be considered in relation to the expiry date for the options. You see in the second table there of 15 October. That means that any option holders who choose to exercise their options will be entitled to the full dividend. Of course, the options have value currently, trading at around 6 cents per option today, and option holders may instead choose to sell their options on market instead of exercising them. Important dates for that, or an additional important date for those option holders who wish to sell their shares, is that the last date the options will be available to trade is the 9th of October. Around 35% of options have already been exercised, and we've made an announcement in our last monthly update around the fully diluted NTA, which today is around 119, or not today, sorry, I should say the last published NTA as of last Friday, 124.7, and the fully diluted NTA is $1.19 per share. Something to bear in mind. Moving on to performance. Now, when we think about performance of a listed investment company, many people choose to compare the performance of a listed investment company to that of a managed fund. Indeed, we have a managed fund that is managed according to the same underlying investment strategy as the companies. So here we have tried to make, as far as possible, an apples with apples comparison. I'll start with the far right column first, so page 5 of the presentation. Clearly in the 20 months or so since inception of the company, it's been a strong market environment. The benchmark, which represents the broad equities market, is up 32%. The APL portfolio, or the portfolio of securities managed by Antipodes Partners, has delivered 28.2% over that time frame, despite being invested or having a low net equity exposure to the market of 64%. So 64% exposure to the market means we are relatively defensively positioned versus the market as a whole. You can see that borne out in the up market, down market capture statistics in that middle column. The number 73 there means that on average, since inception, in down months, the portfolio has only captured 73% of any downside, but 91% of any upside. You can see the defensive characteristics of a long-short strategy coming through there. The left column company represents not only the underlying investment portfolio, but also company-level expenses and also company-level capital management impacts, such as the options dilution. And you can see there, since inception, the company has delivered 23.5%. That's pre-tax, so that's more of an apples with apples comparison with an unlisted managed fund. Now we'll just turn to slide 6 of the presentation. This is really preempting some comments from Jacob on the market and the portfolio as a whole. Just a quick recap on Antipodes Partners, the investment manager. Antipodes Partners was formed in mid-2015, so we've just had our 3rd birthday. The long-short strategy employed by the company is the flagship offering of Antipodes Partners, and alongside that we offer a number of other strategies, global long only and Asia long short, managed by a 20-strong investment team across both Sydney and London. The team has grown from 9 at inception to 20 today. We recently commenced dealing from London, and we have a number of analysts based in London as well. Jacob's over there at the moment, so I'm sure he'll speak to in a moment to help bed down our operations there. We're managing around 7.5 billion in AUM today. We're a value style manager, and clearly value has been somewhat of a difficult place to be in recent times, but despite that, we're very pleased with the results we've been able to generate to date. I'll now hand over to Jacob to share some of his market observations and summarise the portfolio positioning, after which we can take some questions from calls.
Thanks, Andrew, and welcome shareholders. I'm going to pick up on slide 7, just a recap, very brief recap on the Antipodes Partners investment philosophy. Importantly, we are not only looking for great companies which have multiple ways of winning, so aspects to the investment case that we may see playing out, different in a contrarian way, different to the market around competitive dynamics, product cycle, outcomes, regulatory management, and then also using macro and style as tailwinds for our longs and headwinds for our shorts. But valuation absolutely matters. So we're looking for great businesses that also offer a great margin of safety. So if we can combine those together in clusters in a way that are non-correlated, and also at the portfolio level, we believe gives us another way of thinking about risk. So ultimately, generating great risk-adjusted returns for shareholders. In terms of market observations, as we described there on slides 8 and 9, and maybe in our looking backwards, with the benefit of hindsight, we've potentially been too defensive. But a part of the reason for that approach and that attitude is simply the observation that we may be living through the later stages of a major re-rating of assets as a result of very low interest rates. And it's certainly one of when we're stress testing our portfolio, it's one of the key metrics that we're looking at is how does the portfolio behave in a different environment to the one we currently have. As good as it gets, you could also, looking at profit share, which is the orange line, this is measuring the US, which is the market country where we have the longest data series. But really the pattern applies across the world. The benefits of globalization have basically flown to corporates through the ability to outsource via complex supply chains, take advantage of low-cost labour markets, and also tax. Taxes have generally come down. Corporate taxes have generally fallen. So profit share as a percent of GDP is quite high. And the loser in that environment has typically been labour that hasn't been able to differentiate itself. So wages haven't really kept up with profits. So the risks, as we see it, are simply that central banks have somewhat snookered themselves. They've had it's been a very, the strategy or approach of quantitative easing has almost worked too well. It has reflated assets, and that's obviously put money in people's pockets from the perspective of lower rates and just the wealth effect that's come through from higher asset prices. But how, in that environment, when someone's working, it's very hard to become addicted. And as we see, yes, we have a Federal Reserve in the US on slide 11, which is one of the major, obviously one of the major QE, one in terms of its balance sheet, along with the ECB and BOJ. So the three major expansions that we've had, with only one of those central banks, being the Federal Reserve, embarking on any real reduction in that balance sheet, which is what they describe as the policy of quantitative tightening. The problem is, I think, that the Fed is tightening, but in an environment where growth outside of the US, or at least the attitude of policymakers outside of the US, is one which is still somewhat easing for different reasons. You could argue in Europe, it's the ECB that's dealing with political uncertainty, which is keeping it potentially easier than it would otherwise be, given the relatively good growth that Europe is experiencing. And I think that's, when you're thinking about the impact of that, you can see it through the strengthening of the recent strengthening, or the strengthening over the past 12 months in the US dollar, and the pressure that's sort of putting on other smaller emerging economies and the emerging markets that have current account deficits that need foreign funding of their economy. Countries like Turkey, like Brazil. So it's we are dealing with an environment where at the beginning of the year, the headline was synchronized, a synchronized global upswing, and now we're probably moved into an environment of less synchronized monetary policy, and definitely less synchronized fiscal policy. There's only really one major in the economy in the world that's stimulating from a fiscal perspective, and that's the US. So the Federal Reserve is dealing with a super aggressive fiscal policy in the States and trying to offset the natural growth, with the US economy doing relatively well, with the consumer feeling as, the US consumer is seeing consumer confidence measures that haven't been experienced since the tech bubble in 2000. So there's really no need for fiscal stimulus in the US. It's almost a reckless policy to adopt, given how strong the economy, relatively strong the economy is. So that's, leading, I think, to the volatility that we're currently experiencing across different asset prices, currencies, and we think that's here to stay. We're moving into a tighter monetary environment policy, and one needs to consider that in their asset allocation and ultimately exposures that they're adopting in the equity market, which takes me to slide 12. The choices that we've been given are quite stark. The valuation of, if you see the red tones there, on a long-term view of valuation, what sectors are trading above their typical rating, and those sectors that are trading in the blue shades below their typical rating. And if you can see, a lot of what's red is actually the global, what you could describe as the global multinationals in the sectors of the consumer staples, technology, and materials and healthcare. And then on the blue side, we see a lot of the three sectors there are much more what we've described as domestically or locally oriented sectors: financials, communications, and domestic cyclicals. It's almost as if investors have said, local macro risk, whether it's in North America, developed Europe, developed Asia, or emerging markets, we're not interested in that. And so the same stocks that are cheap across all those markets, and the same sectors that are expensive are actually expensive across all those markets. So there's a crowding effect taking place in markets. So turning to slide 13, how has Antipodes deployed how have we constructed portfolios today to deal with the opportunity set? We in our approach in creating these non-correlated alpha clusters, we certainly have a mix across those different parts of the market. Yes, we see in our consumer incumbent, incumbent exposures, some of which are global, more in that multinational part of the market, some of which are domestic, where we've got stocks like Tapestry in the US, the owner of the Coach brand, and Yamato in Japan, which is one of the most dominant sort of express freight companies in the world in terms of measuring that in terms of its market share, in excess of 50% market share in the Japanese express freight market, and benefiting from the strong growth in e-commerce. And then in financials, where we see a company like Ping An Insurance in China, which is the leading private sector life insurance company in that market, with a strong technology platform which allows it to very efficiently acquire customers and cross-sell products. Company growing, we believe, in a part of the market where the penetration of life insurance is still very low in China, and you have a market share gainer. So we think can sustainably grow in the high teens at a very high level of profitability. Dropping down into some more multinationals, where we've got our healthcare exposure in Gilead, a company that we see also coming into its own after a long period of restructuring its portfolio, is Siemens. Siemens has, in a world where we're moving towards a lot more automation in factories, across supply chains, Siemens has got the world's best software, hardware, integrated automation offering. And because it's inside a conglomerate structure, we don't believe the market's reflecting the value of that crown jewel. However, Siemens management is committed to unlocking that value. And also, one of their other very strong businesses, the gas turbine business, we believe it's coming out of a cyclical downturn and entering a period of structural growth. And that takes me to natural gas, because it's changes in the natural gas market that are driving that structural growth in Siemens. And if you think about this as a commodity, natural gas is priced in the US below the cost of extraction, which really excites Antipodes Partners. When we find a commodity where the spot price is so low that producers are being forced to ration supply, and you can see a great outlook for demand as China and Europe switch to using a lot more natural gas in their the fuel mix for their power sectors. You've got a great opportunity to benefit from a supply-demand rebalance. Our online exposures, we would argue we're fishing in the parts of the tech sector that we think are offering value in a sector that's generally overvalued. There is still interesting companies that are growing sustainably that are at low enough multiples to make them interesting, whether it's the two search companies in the world, Alphabet and Baidu, or a social media platform, chat platform that dominates in Japan, Line, and so forth. Look, we've got a portfolio, as I said before, where we have exposure to those very cheap domestic sectors, but in a risk-aware way, where whilst we exposure in a sector basis to financials, we've got it well diversified, as you can see there, in the domestic recovery cluster, in financials that are diversified by region, with dominance in KB Financial in Korea versus UniCredit and ING in Europe. Telco incumbents, as many investors would be aware, probably through the Telstra experience, this is a part of the market that is quite unloved, but paying what we think are now very sustainable dividend yields that can grow, and And we're quite excited by the outlook for dominant incumbent telecom companies. Software incumbents have been a great place to be, re-rating across Microsoft and Cisco, and then low-cost oil. We're certainly seeing a rebound in CapEx there. On the short side, look, the shorts we've spread across these 5 different clusters. Certainly, we're looking for a balance in the short book where we can benefit from some of the sectors that are going through a cyclical downturn, as well as in the overhyped growth cluster, looking at some of the weaker growth stocks that are celebrated currently by the market that are potentially vulnerable to a reset in expectations. That brings me to the end of really my discussion around the portfolio and positioning. We've got 2 stock examples there that I'm not going to go into in detail. And I'm going to finish up really on slide 18, where we have a lot more detail on the portfolio positioning, and hand back to Andrew Findlay.
Thanks, Jacob. So you would have heard there some examples of the stocks and clusters that the portfolio is invested in. Further detail is included in our quarterly reports available at our website, antipodespartners.com. Clearly a lot of ground to cover in a call like this today, so I encourage you, if you're interested in exploring any of those clusters or stock ideas further, to have a look at our website where we have significant information about how we invest and some of those cluster ideas. Now we'll throw over to any questions that shareholders may have, and I'll pass back to Lisa.
Thank you very much, Andrew. If anybody would like to ask a question, press star 1 on your phone now, please. So star 1 to come into the queue for a question. Thank you, Andrew. Our first question is from Ben Stiles. Go ahead, please, Ben.
Oh, good day, guys. I saw an article on Bloomberg today that titled "Short Bets on World's Biggest Tech Stocks Says to 37 billion." I was just wondering if you were doing much investing around these FANG stocks.
That's a good question, Ben. Yeah, look, we've on the long and short side, we see, as I said earlier, some of the if you think about the growth that you have, ongoing growth in businesses like Baidu and Google via Alphabet, we don't believe in the case of Alphabet that the market's recognising the value of YouTube or the emerging opportunities in autonomous driving. And in the case of Baidu, it's concerns, I think, around the Chinese macro that are holding back the valuation. So in the case of Baidu, we're looking at a stock that's trading on a PE of 15 times, in 18 months, 2 years out. That's still growing in the core business, towards between 15 and 20% in its core business per annum. So very cheap for the growth that you're getting. On the flip side, you can see companies. If you think about some of the valuation of the high-flying, but I would argue lower quality stocks, and we've been quite public about a company like Tesla as being a relatively weak position, relatively weakly positioned. Whilst we're not currently short a Netflix, I think it's a great example of one of the FANG-like stocks where investors are not considering how large the margin of error might be around what their margin structure will ultimately look like, because they've got strong competitors in scripted drama. You've got competitors like Disney. You've got YouTube. You've got Amazon moving into that market, and so the fight back from the incumbents in some of these new media platforms or social platforms is real, and I think that's going to throw opportunities on the short side.
Okay, you're still there to speak if you wish to say anything, Ben?
Thanks for that.
Thank you. Thank you, Andrew. Our next question is from Simon McLuhan. Go ahead, please, Simon.
Thank you. My question is, when you look around the world today, where are you finding the most attractive opportunities?
Thanks for the question. The best slide, just to, if we can go, but once again on slide 12.
Yep.
If you look at the way that the market's pricing some of these domestically exposed sectors, and you take the case of developed Asia, dark blue. So developed Asia financials, this is dark blue. So the stock we own, KB Financial, it's basically growing credit at around 5% grown, so it's lending. Its loan book is expanding. The Korean economy is doing well. You're buying that stock on point. The ROE in the business is moving above 10%, so net interest margins are expanding. And the company, for a Korean company, this is a company that has done buybacks now. It should be doing more buybacks because it's got surplus capital. But you're buying that business on basically a PE of around about, it's on 0.5 of book, 0.6 of book with 10% ROE. I mean, the PE is 6. To us, that just seems like too cheap. Too cheap. Even wanting to put a discount on it for being a Korean stock, where capital management needs to improve, we think that's just too cheap. But it typifies the sorts of domestic opportunities that you're getting across the world. Even in North America, it's the cheap part of the US stock market, even though it's, if you look at the difference in US financials versus financials ex-US, the US ones are least, in a relative sense, they're the least attractive.
Yep.
But if you understand what I'm saying.
Yeah.
Communications. I think investors need to reconsider in the world that we're moving into. There's a lot of fears around what the telco companies will have to spend on 5G capex. There's concerns about the potential for new entrants. We would argue a lot of those concerns are overstated, and there's lots of examples of if you take Korea, you take China, where the capex in these companies is actually falling below depreciation because they've already gold-plated their 4G deployments plus their broadband networks. So from a regulator's perspective, it's not like Australia. Right? You have the opposite. You have some of the world's best service levels in terms of speed, reliability, and so the regulator's not forcing these companies to increase capex, and is allowing them to make to grow cash flows faster than profits, and they're trading on incredibly low valuations. We believe you're getting cash flow to equity in a company like KT of between of close to 15% per annum. I mean, the company trades on an EV/EBITDA multiple of 2.5 times.
Fantastic. Thanks for that, Jacob.
Thanks.
Thank you, gentlemen. We don't have any further questions in the queue.
Thanks, Lisa. In that case, I think we'll just wrap up the call in the interest of time as well. I'd like to thank everybody for your time this afternoon. Just summarising a few of the key dates that I mentioned earlier on in the presentation. Firstly, the dividend ex-date of 19 October and the option expiry date of 15 October. So anyone who exercises their options by the expiry date will be entitled to that maiden 5-cent per share dividend. The board of the company is committed to enhancing shareholder communications, and this call is hopefully an example of that. We've also published a lot of information on our website, so once again go to antipodespartners.com and click on the APL link. You can also email us at invest@antipodespartners.com. And just in closing, I'd like to thank you for your support of the company. We look forward to delivering attractive returns over the years to come. Thank you, everybody.